We are looking at futures that are off bigly. 30 minutes until the start of trading. I'm Matt Miller.
I'm Sonali Basak.
And I'm Katie Greifeld. Bloomberg Open Interest starts right now.
Coming up, tech disappoints. Tesla posts its fourth straight profit miss as Alphabet faces pressure to keep up on AI.
Blackstone's mortgage REIT cuts its dividend by 24% just days after Carson Block warned us that it may face a liquidity crisis.
Spring into action to quickly fill Kamala Harris's campaign war chest. We got the scoop on their plan. We'll bring that to you. But let's take a look at markets with about 30 minutes until the bell rings, because it is not pretty. Of course, we got earnings from Tesla, from Alphabet. They did not go over too well. You can see the S&P 500 down about 1% pre-market, even worse. If you take a look at big tech, the NASDAQ 100 off by nearly 1.5%. The bond market may be a haven bid coming through here. You have 10-year yields down about 4 basis points, Matt.
All right, I have a chart for you, Katie. This shows the rotation. So what I've got here is the Russell 2000 minus the Mag 7. Remember, we're watching these small caps for a resuscitation in earnings season. Certainly investors think it's happening, bidding these small caps up, bidding up the Russell 2000 over the bigger cap tech stocks. Sonali?
And in order to rotate, you have to sell something, and Tesla shares are being sold off right now. Shares slumping after its fourth straight quarter of disappointing profits, delaying its robo-taxi unveiling to October. We have Tesla down more than 8% pre-market. Alphabet also down 4.3%. Alphabet shares dropping as investors wait for AI to finally start paying off.
Yeah, and it's not been doing that. Certainly not in Europe. We've got bad earnings news there, right? We had LVMH, Louis Vuitton sales actually expected now to drop for the full year rather than stay flat. Deutsche Bank posting its first quarterly loss in 4 years, saying it's possibly going to pull back on a second buyback. And then you get into the U.S. and Tesla's no good as well.
I was going to say, you're starting the show with Europe. I thought that you were all about the USA.
You just see the bad news coming through from the continent across the Atlantic to us.
Fair enough. And there is a lot of bad news to parse this morning. Tesla shares, Elon Musk saying, if you don't believe in autonomy, don't have this stock. Sell the stock, and certainly people are doing that this morning.
Yeah, remember when glass half full Matt existed yesterday? It's a little glass half empty today, isn't it? But Tesla is the big story to start the morning.
I mean, but there are many more, right? Otis isn't selling as many elevators.
Oh, no.
And Aston Martin, those revenues dropped 11%. On the earnings call, though, for Tesla, let's focus in on that. Elon Musk spoke about the robo-taxi delays.
I wanted to make some important changes that I think would improve the vehicle, the sort of the robo-taxi, the main thing that we're going to show, and we're also going to show off a couple of other things.
Joining us now for more is Ed Ludlow, co-host of Bloomberg Technology. And Ed, you watch this and report on this company very closely. In fact, you broke the news that the robo-taxi would not be coming in time. How are investors taking this?
Yeah, in the first instance, the headline that the robo-taxi unveil will be October 10th instead of August 8th. I don't know that that's what the anxiety in the market is. It was only ever going to be prototypes anyway. On the call, a couple of analysts had a stab at trying to get Elon Musk to explain the bigger picture, which is that ultimately Tesla hopes to operate a proprietary ride-hailing app, similar to Uber, where you request a car that drives itself, and it is either an existing consumer car with the necessary hardware or software, or it's the purpose-built robotaxi. And if you read the language closely in the shareholder deck about how they intend to manufacture that, it would indicate that it is a distant product well beyond 2025, or at least after 2025. So I think that's the problem. Investors are looking at all of this information, digesting the call and saying, I don't see the jump from where we are with full self-driving software being tested in consumer cars to this very big end goal.
You think about the momentum, and this morning New Street Research coming out with a downgrade of Tesla's stock, saying that margins will take time to recover. How much patience is there now among the investor community and the sell side?
Just looking down at my my Bloomberg terminal, because I think that was Pierre Ferragu. Am I right about that? I think that's the first time he's not had a buy rating or a super bullish call on the stock for 3 years. So that's kind of interesting. However much credence you put to the sell side, the reality is that also the fundamentals of its core business are also dwindling. I think you pointed out, Sonali, 4 consecutive quarters where the bottom line has missed expectations. Now, a bright spot was that this was a record quarter of revenue, 2% year-on-year revenue growth, when the street thought it would be a continuation of decelerating or shrinking year-on-year revenue growth. And some of the other parts of its business outperformed: energy storage, battery installation, an incredible number of ZEV credits, for example. But they still have a problem with selling EVs right now. And they listed all the factors behind that, ranging from the economy, competition from hybrids, and automakers kind of not helping them out, right? We think, we talked a lot on this show about everyone bailing, going back to combustion engine or hybrids, and Tesla pointing out that's not helping us in the here and now. That's kind of got the established Wall Street investor, who may not buy the thesis that long-term cars are the smallest part of the business, a little worried.
And Ed, just quickly here, I want to talk about the ripple effects of what we heard from Elon Musk last night, specifically when it comes to NVIDIA, which is down over 2% pre-market. We heard Musk basically say that there's been a doubling down that they're doing on the Dojo supercomputer, that Musk is concerned about getting enough NVIDIA chips. Walk us through those comments, just briefly.
Yeah, in training its foundation models or transformers, Tesla uses both its own proprietary silicon, Dojo, and it uses NVIDIA's H100. Musk said it's been really hard to get hold of the H100 when they need it. In other words, NVIDIA is supply constrained, and so they are going to focus on their own chips out of concern that they won't be able to access NVIDIA's tech as and when they need it. Supply constraint is usually a good thing for the seller because demand outweighs supply, but clearly I think everyone's looking at NVIDIA's ability to deliver its tech to a key name.
Yeah, it's a fascinating point there that those supply constraints, they're good for a certain amount of time, and maybe we're reaching that inflection point here. Bloomberg's Ed Ludlow, thank you so much. Let's keep the conversation going now with Callie Cox. She is Chief Market Strategist now at Ritholtz Wealth Management. Callie, it's great to have you with us, especially as we finally have some real earnings to talk about. And so far, not going over too well. When you think about what we learned from Alphabet, what we learned from Tesla, what can we extrapolate out to the rest of big tech and really the rest of the market from there?
Big tech has been a victim of its own success here. And I say that because if you look back at the little bit of earnings season that we've seen, we've actually seen some quite good results. 80% of companies are beating earnings estimates. Revenue is coming down, but this is a cost-cutting environment for corporate America. So that's frankly okay with me. I'm looking at the everything else when it comes to earnings season. Obviously, tech is a big part of the market. Tech has been the big story for most of this year, but everything else is starting to contribute in. And I'm fine actually giving away a little bit of tech strength if it means that more stocks can participate in this bull market.
So does that mean actually selling tech stocks, the big mega caps, taking those profits to buy smaller cap stocks?
Well, yeah, I think if you're a tech investor, I think if you're heavily concentrated in tech, you're probably sitting on some nice gains right now. And the risky side of me, being an analyst who looks at the pros and cons, would tell you to consider rebalancing, understand what's in your portfolio, but understand how you got here. And frankly, we're telling our clients to do that as well. Look for value in this market because there's a lot of value and it's not just a tech focused market anymore.
Callie, if you take a look at the expectations for rate cuts, yes, there's one for September, but you think about what Bill Dudley wrote this morning for Bloomberg Opinion, the idea that waiting that long could create unnecessary recession risks here. And if you get to the point that the economy weakens, then is this rotation really sensible into those small and mid-cap names?
I read Bill Dudley's opinion this morning. I certainly think the Fed has an argument to cut in July. I'm a little less scared of the future. I still see a solid job market. I still see contained layoffs. I see profits rising in corporate America, maybe outside of tech. So I think the Fed has time to wait. And this Fed is very measured. They like to give you a hint before we actually see any kind of big rate switch or, rate move coming. So I wouldn't be shocked if they waited until September. I think they have the breathing room to do that. But with where inflation is now, or inflation data that we're seeing, I wouldn't be surprised if they went ahead and did the thing in July.
Yeah, it remains to be seen, of course, to your point. This isn't a Fed that likes to surprise the market, but the data has definitely been interesting. But let's focus in a little bit more on small caps. We actually heard from Julian Emanuel a little bit earlier. Let's take a listen.
When an asset class has been abandoned as much as that, when it is trading at a valuation discount to history versus, large caps and NASDAQ as it is. And when you have, in our view, policy behind you in an environment where even if we do have a downturn, it's likely to be a mild recession. That's an environment that we think is going to work.
That, of course, was Julian Emanuel of Evercore ISI. And on that point, Callie, obviously Julian sees some durability to this small cap rally, but it seems like a lot of the bullish notes are pinned to the fact that valuations for small caps are so depressed. When you look at the fundamentals, though, are they there?
First of all, I agree with Julian there. If you look at where small caps were relative to large caps, the discount between small cap valuations and large cap valuations was at a 20-year high before this big rotation happened post CPI report. Small caps have been so unloved for so long that I'm not surprised that we've seen this frantic rotation back into small caps and rate sensitive sectors of the market. I think the question is how far it will go right now. I think there could be some bumps because markets frankly just don't go straight up over time. And there are some concerns there, right? We still see a lot of value in small caps, but at the same time, the question that we're grappling with right now is how far can it go? And I think that it's a question that's hard to answer right now.
Callie, I think it's pretty clear that a lot of people in the market think that things could get choppy before they get better. Julian Emanuel being one of them. Mike Wilson also over at Morgan Stanley. If you think that we could hit some road bumps before the election in the stock market, why not wait? Why not wait until valuations correct a little more?
Well, look, there are so many good reasons to invest in the stock market right now. I always remind people of the upside risk, for lack of a better phrase. If you discount this market could pass you by. And right now, we're staring down celebratory Fed rate cuts, the kind of rate cuts that come when the Fed feels like it has the economy back in balance. And we're doing that against the backdrop of a strong market. I think it would be foolish to discount where the market could go by now. So we're telling investors, believe in this bull market, understand that there's really strong support, especially if we see this rotation continue. And until we see a breakdown in the job market, it doesn't make sense to abandon stocks. But it isn't a zero-sum game, right? Maybe look at bonds a little bit more, maybe look at cash a little bit stronger, even if rates are coming down a little bit. Understand that you can take on a sanity hedge while still being optimistic about the future.
All right, Callie, thanks very much. Callie Cox there, Ritholtz Wealth Management, giving us her view on the market. We are looking at the market broadly down in terms of futures. There is some deal news here. T-Mobile and KKR are going to establish a joint venture to buy Metronet. That's a headline just crossing the terminal. And in the telecom sector, we also saw AT&T add more subscribers than had been expected. That stock is up in the pre-market. We'll dig deeper into those moves after this. Coming up, Blackstone cutting its dividend on its mortgage REIT by 24%. More on the move and why they felt it's necessary next. This is Bloomberg. Let's get now to high interest. Look at what's making headlines around the world. Sales growth at luxury powerhouse LVMH slowed last quarter as wealthy shoppers in China reined in spending on pricey Louis Vuitton handbags and Christian Dior couture. The company has proven more resilient than other luxury houses to China's economic slump, but this quarter sales tumbled 14%. Meanwhile, Deutsche Bank shares are plunging in Europe after seeing its first quarterly loss in 4 years. The bank says it will most likely refrain from a second share buyback this year. It's Germany's largest lender. It also warned that provisions for loan losses will be higher this year than it had previously expected. And Blackstone Mortgage Trust is cutting its dividend by 24% on rising defaults, increase in struggles for borrowers to either make payments or refinance. The board of the $3.4 billion real estate investment trust, known as BXMT, authorized the repurchase, though, of $150 million of stock to lift the value of the shares. Sonali?
Meanwhile, short seller at Muddy Waters, Carson Block, made the decision to short BXMT back in December. He was on air on our program just 2 weeks ago and explained the rationale regarding the dividend.
Our thesis from when we unveiled it in December of last year is that in the second half of this year, BXMT is going to cut the dividend. A lot of these loans are in trouble. BXMT has not trued them up in terms of the risk ratings. So we believe that as more and more of these loans are allowed to pay in kind, that in the second half of this year, BXMT is going to have to cut the dividend.
Want to now take a quick check on some of Blackstone's competitors here, because of course there are a lot of publicly traded REITs, some of them now down pre-market. KKR Real Estate Finance Trust dropping 1.8%, the worst of the pack really, but Arbor Realty, Apollo Commercial Real Estate also down on the day. Joining us now for more on Blackstone, we are joined by Nir Kassiar of Bloomberg Opinion. And you think about Blackstone, and the reason it becomes worrisome is because Blackstone is kind of the gem in the room. It's been considered the safer of assets. And if you extrapolate across the real estate industry and other places you could see problems, what do those problems look like?
Good morning, Sonali. Yeah, I mean, I think we have to talk about the big question, which is when we're talking about commercial real estate, are we going back to pre-pandemic work life or are we not? And this is something that we've been struggling with for years. And my view since the beginning, since the pandemic, has been that we are not. And the reason we are not is because it doesn't make any sense. Now that we have the technology to be able to do work anywhere, it doesn't make sense for someone who lives in a suburb to commute an hour each way to go into the office and do the exact same thing in the office, sit at their desk and respond to emails that they could do at home, or they could do in an office closer to their house, or however alternative arrangement that you can conceive. And therefore, I think because of that, we are in a process of a multi-decade sort of secular change in where we work, how we work, et cetera. And I think there's a lot of denial about that. There's a lot of denial, I think, from, excuse me for saying, sort of older generation of workers who want to see us return to pre-pandemic levels. And also from commercial real estate investors who don't want to have to make hard decisions about taking losses, about converting real estate properties, et cetera. But the more we avoid this question, the more it's going to come back to us. And this is, I think, one of many sirens that are going to come
And
our
also
way.
from Blackstone, right? I mean, wasn't there denial there? I'm getting like Democratic Party vibes. Like, he's fine, he's fine, he's fine. No, he's not going to run. Do you get that too?
Well, apparently we're going to see President Biden at 8 p.m. tonight, so that'll be very interesting. But I mean, near to that point that there needs to be this realization of what you're saying, that things aren't going back to pre-pandemic levels when it comes to office occupancy. What does BXMT, Blackstone, and all these other REITs do? Because you take a look at BXMT specifically, they say that they've cut net exposure to offices by $1.4 billion over the past 2 years. They've cut the dividend. Is it enough?
Well, they're going to do the only thing they can do, I think, which is what you're referring to, which is they're going to pivot and they're going to make some unflattering announcements along the way until they can pivot out of the space. And ultimately, whoever's left holding the bag will hold the bag. But I think there's going to be some bad news to come. And, whether it's enough or not, one way to gauge that is obviously by their exposure. But there's another way, which you can look at the historical yield on mortgage REITs, and you could see where they are relative to their historical average and their standard deviation. So, for example, I was looking at the numbers this morning. Right now, the yields on mortgage REITs are a tad bit above their historical average, which tells you that if there was any enthusiasm in the space, it's gone out. But it's not even a standard deviation above that average, which also tells you that there's a lot of downside still if what I'm saying is right, ultimately, that mortgage REITs, commercial properties are going to suffer in the next 5 to 10 years, let's say. You're going to see more pain in those yields. And so I wouldn't say we're anywhere near distressed levels yet.
Nir, I don't know if I'm just a moron, but what does it mean? I know that I'm a moron.
You are not a moron.
What does it mean that they're cutting the dividend but then buying back $150 million in shares? What does that tell you about Blackstone's strategy or thinking here?
Well, the cutting that I think they're anticipating that there's going to be defaults, which is clear. I mean, that's one of the things we haven't seen yet is the wave of defaults that are going to come, because there's some stub period. Interest rates went up, but there are current loans in process. Usually they would go to refinance them. Now when they go to refinance them, the interest rate is going to be a lot higher, and that's going to be problematic for their P&L. And so you're going to have defaults. And so I think Blackstone is trying to get ahead of it. By cutting the dividend, they're trying, I think, to conserve some cash. And by buying back shares, I think they're trying to, I don't know for sure, Matt, but I think what they're trying to do is they're trying to add some control to their own portfolio, their ability to pivot the portfolio into places that they think there's going to be a higher return and a lower risk going forward. That's my read of that, but I'm not entirely sure, to be honest.
You know, you think about the bid that you've seen in the banking sector recently, the KBW Bank Index, 5 out of 7 days has been in the green. And then you see this morning Deutsche Bank moving to put aside more money for souring loans in the real estate sector. And for those who don't remember, it was Deutsche Bank, JP Morgan, some of the biggest lenders. But of course, the regional banking system now more exposed. Do you think what's happening at Blackstone signals more trouble than investors are currently baking in because they're so excited near about those rate cuts?
For sure. I mean, I think everybody's in denial about this is my broad view. The question is, who's going to be left holding the bag? I don't think we have our arms around this yet. How much exposure do regional banks have, and what does the quality of that exposure look like? Because even in a distressed market, which we're not there yet, but even in a distressed market, there's going to be quality among and along the commercial properties and who's holding what. And, in general, the more sophisticated players tend to be savvy about holding higher quality. So knowing nothing, I would say that I would be concerned about the regional banks. But this will unfold, I think, hopefully slowly and not quickly. I mean, we don't want a crisis on our hands, but hopefully this will unfold slowly. There will be a wave of defaults. We'll be able to manage through it as an industry. And hopefully the folks who are holding the lower quality properties will be able to get some help. But, that's, I think, best case scenario in my view.
All right, Nir, that's a good place to leave it. Always great to speak to you. Hope to do it again soon. That is Nir Kassiar of Bloomberg Opinion. Now, coming up, we'll take a look at the companies making the most social buzz today in our Social Climber segment. Up next, this is Bloomberg. All right, it's time now for Social Climbers, the companies making waves this morning. And first up, we have Texas Instruments. Sales forecast there stoked optimism that orders may now be on the rise. That's helping to counter fresh concern that was caused by peer NXP Semiconductors, which on Monday gave projections that fell well short of estimates. Next up, Visa posted quarterly revenue that just missed Wall Street estimates, a rarity for the world's biggest payments network. Worldwide card spending climbed 4.9% from a year earlier. And in the U.S., where Visa gets roughly 40% of its revenue, spending advanced 5.1%. Finally, CrowdStrike says that last week's meltdown was caused by a bug in a safety mechanism that allowed flawed data to go out to customers in a botched update. The firm, which is trying to piece together the series of events that led to one of the most spectacular rolling IT failures the world has ever seen, says that it will improve the testing of its updates. You can follow all the latest company buzz on TREN Go on your Bloomberg terminal. Coming up, we'll speak to RockCreek's co-chief investment officer next. This is Bloomberg.
25 seconds to go until the start of trading. This is Bloomberg Open Interest. I'm Matt Miller. We have futures that are down across the board. Even the Russell 2000 futures are falling right now, so no rotation today. S&P futures down almost 1 full percent. Concerns after bad earnings came in from Tesla last night and then from Europe overnight. Can this market recover if the mega cap tech stocks aren't pushing up and we don't have the Russell 2000, the small caps in that rotation playing along? Let's go over to Katie Greifeld right now. She's got a look at your live index trade. Katie?
Yeah, of course, as the bell rings, you can see it's exactly like you said, a down day in the markets. Big tech not exactly coming to save the day. In fact, doing the exact opposite, because the S&P 500 currently off by about 0.9%. Your biggest loser, of course, is big tech, down 1.4%. And like you said, small caps actually the relative outperformer, but still down by about 0.6%. Now, one stock we're keeping an eye on, of course, another earnings story here, but a good one. AT&T shares higher after posting a surprising gain in mobile phone subscribers. Shares currently up by about 4%. Sonali.
Also at the open, keeping an eye on Visa, down more than 3%, reporting a rare miss in quarterly revenue. Of course, not only that, sending the stock lower, payment volumes as well, Katie, on the decline relative to expectations here.
All right, Tesla continuing to fall after missing earnings again. It's the fourth quarter in a row where Tesla has missed earnings expectations. Also, it's delaying its robo-taxi. They're not going to have a humanoid robot until 2026. They're not going to have a cheaper car alternative until, at the earliest, the first half of next year. Let's get over to Abigail Doolittle. She's got a closer look at the stocks.
So investors are a bit disappointed here, Matt, but I would argue that maybe it has to do with the fact that this stock off of the April lows until the recent highs up about 90% trough to peak. Today, down 9.2%. This is the worst day since January. And as you mentioned, they did miss the earnings estimate by about 14%. That had to do with the gross margin. But similar to Amazon, I would say in some ways they maybe are pulling in Amazon. They are spending for the future. If we take a look at cars sold revenue, this is getting lost in the shuffle, actually beat by 3.5%. They put up $25.5 billion in revenue. The amount of cars sold in the second quarter up sequentially, sort of around the mark for the last few quarters. So Elon Musk saying, if you don't believe in autonomy, then Tesla's not for you, encouraging people to sell. You did mention that they delayed the robo-taxi. This is all about the robo-taxi, but it's not just a car, an autonomous car that will drive people from point A to B. It's also about distributed power. It's about supercomputers. If we take a long-term look at Tesla, we were talking about this yesterday, Matt, in the Bloomberg terminal, we are going to see a beautiful uptrend, frankly, but you can also see that it goes wildly above it. Sometimes it goes a little bit below. What's interesting, right now, we are holding this uptrend perfectly, breaking out of the resistance. The RSI is climbing higher. So I would actually suggest that this chart, so long as these trends hold, and right now they are, points to the big future for Tesla, that it is about autonomy, and that investors, maybe new investors, will be coming in to really wrap their minds around an overall ecosystem of AI and autonomy.
All right, not really about a car maker, but more about a tech company. That's, I guess, the argument that bullish investors have been giving us for a long time. Abigail Doolittle, thanks very much for that. Joining us now is Alifia Doriwala, RockCreek Group Co-Chief Investment Officer. And Alifia, we've had some pretty disappointing earnings news when you look at the macro implications of, Otis, the gigantic global elevator maker, having to cut its forecast. LVMH having to forecast sales that are down and a drop of 14% in the quarter. Deutsche Bank having its first quarterly loss in 4 years. And Tesla, of course, disappointing for the fourth quarter in a row. Are you worried?
I think this just shows how important earnings season is, right? So earnings season is obviously just getting started, but it is going to be extremely important for investors in the market, because up until now, the market and the investors have really had to care about two things, right? This year, one, what is the Mag 7 going to do? And two, data. It's all been about data, inflation, interest rates, job reports, consumer spending, because that had implications for fiscal policy. I think today, as we start earnings season, it really is, what is the rest of the market, meaning those smaller companies outside of the mega tech, going to actually be able to meet or exceed expectations, so investors have the confidence to sustain this shift in sentiment that you talked about that we've been seeing and buy into the rest of the market. And as you mentioned, expectations have just been so high across the board going into the market. And so it's really not even just about big tech. I think it's about all these other companies, and will they be able to have the positive growth momentum that we want to see to be able to have confidence to buy into the rest of the market as we head into the rest of the year, which is, I think we're at an interesting potential inflection point in the market today.
Alifia, when we take a look at certain companies, you look at UPS yesterday, you look at Lamb Weston today, shares sinking as much as 25% at the open, the biggest decline since March of 2020. You're seeing comparisons to moves that we've seen in tough times, 2008, 2020. How much negative sentiment is under the surface? You've seen a lot of bullishness, of course, in the recent months, but these one-off names are coming out showing you tough stories. How do you read that?
I don't think it's surprising that we're going to see pockets of softness in the market, given where we are today and where we've come from, right? But I will say that this is a great opportunity for active management. It's a great opportunity for fundamental stock picking. As a long-term investor, this is a great time to be looking at your active management, your active risk in your portfolio, because we are starting to see stock prices actually react to fundamentals. And I think this earnings season is really going to highlight winners and losers in the shorter term, but really set us up for longer term. Where are we seeing pockets of trends that we want to be able to invest in? I mean, there is so much innovation happening in the market, but it's over a longer period of time, right? So sometimes these shorter term noises around earnings gives us some data points to see where the longer term trends are going. For example, innovation in healthcare, energy transition, fintech. I mean, these are all areas we're very excited about. And we're starting to get clues from some of these companies in terms of how those trends are going to materialize, again, for the longer term.
So how would you go about action on those industry groups? I mean, what do you like specifically? Do you buy individual stocks? Do you want to track an index? Do you like ETFs? How do you do it?
So again, we are all about active management in this market and going forward for the rest of the year. We think you're going to have to really be very selective. And so passive index investing is maybe not the best way to position your portfolio, rather looking exactly and specifically at who is actually going to be able to make money in which specific sector. And, we have the luxury of investing in both the public markets and the private markets. And so if you look at the private markets today, there's been a lot of, hurt in the private markets over the last 2 years, given how we've seen distributions coming from private companies, given the lack of IPOs. But it's a great opportunity if you have fresh capital and the flexibility and the liquidity to be able to invest into this market. So specifically healthcare, for example, precision medicine, efficiency and scale in medical services, preventive medicine, reimagining insurance, biotechnology. I mean, these are all areas that are ripe for investment and opportunity. But to your point, you have to be selective. Unfortunately, you can't just buy an index.
But to that point, I mean, we've been hearing that for a while, that it's a stock picker's market, especially, with the volatility around what the Fed is going to do, earnings sort of have and have nots there. But even still, you take a look at most measures of tracking active management. I watch ETFs very closely, for example. We've seen a ton of money come into active management, haven't necessarily seen the performance to match that. It's certainly quite hard to outperform the indexes that you say that investors shouldn't be buying right now. So what's going to change? Why would this experience be different?
Yeah, I mean, I think you have to, take what you've learned from looking backwards, but then look forward. I mean, I agree with you 100%. It has not been a stock picker's market up until now, but I think we're starting to see a fundamental shift in investor sentiment. And if we can let the Mag 7 lose a little bit of the control that it has had over some of those indices, over some of those markets, I think you're going to have a much more interesting market where you will have the opportunity. But again, I think it's going to depend on how we see earnings season play out, and it's going to depend on how stocks are reacting into earnings season. And I think we do have a political uncertainty with the elections in November that's going to be an overhang on the market as well, right? That might have longer term policy implications for your portfolio that you have to think about. But in the shorter term, we also might see some more macro, I would say, headwinds in terms of the markets. And really, active management has had to suffer through those market headwinds for quite a while now.
Alifia, one thing I don't believe you mentioned in your list of exciting investment ideas at this point is artificial intelligence, or at least you played up other parts of that thesis. You have the Philadelphia Semiconductor Index, almost every stock in the red right now. It's down another 2% nearly today. NVIDIA is down more than 3% starting the day as well. Do you think that the ripple effects, the weakness you're seeing, for example, today in tech, has kind of an increased effect here on the semis, especially when you see kind of that negative sentiment feeding through in recent weeks?
So it's funny you say I don't mention AI, because I think it's almost like investors take it for a given now. AI is across every single one of your investments in your portfolio, whether you even know it or not, right? And it's beyond just investing in the inputs into AI. So looking at the semiconductor, looking at big tech, it's across every single sector and industry that I mentioned as well, because that's how the innovation is happening, the application of AI towards those sectors. And so, we are looking at how to invest in AI across a multitude of areas. But again, it's not a shorter term earnings season call, right? This is a 10, 15, 20-year trend that investors are really going to have to get right in their portfolio and pick their spots to be able to make money from how AI is going to transform sectors, and how fast AI can transform certain sectors.
Alifia, we thank you so very much for your time. That is Alifia Doriwala of the RockCreek Group. And coming up, the analyst action that you need to know this morning, that's up next in our top calls. Stick with us. This is Bloomberg.
All right, it's time now for Top Call. Some of the analyst action in focus this morning. And first up, New Street Research cutting Tesla to neutral. The firm cites margins taking time to recover and a lack of near-term share catalysts for the downgrade. Tesla shares down by almost 11%. Next up, Morgan Stanley downgrading General Motors to equal weight. Analyst Adam Jonas sees little scope for further gains for the automaker. And finally, RBC upgrading Estee Lauder to outperform. The firm says that the risk to reward profile of the cosmetics company now skews favorably, Matt.
All right, very interesting, and I believe that company was founded here in New York City. All right, quick check on what's going on in stocks. We have a loss of more than 1% on the S&P 500 just 15 minutes into the session. The NASDAQ falling almost 2% here, and I think it's notable that the Russell is basically unched. I would like it. You know what? I've gone from wanting to see the Dow Jones Industrial Average on these boards to wanting my WEI function to have the Russell 2000 straight on the opening screen.
Of conviction.
Well,
shifting conviction.
Shifting. Well, I'm just saying.
There are other people shifting conviction this morning, too.
Great tie-in to Mr. Bill Dudley, which I'm sure we'll get to.
Some breaking economic news that we're watching here, just crossing as well. We've got S&P U.S. manufacturing PMIs at 49.5. We were looking for 51.6, so a little bit less than expected. Services PMIs a little bit better than expected at 56. We were looking for 54.9, and the composite at 55 is a little bit better than the 54.2 in the survey. Let's talk to Michael Mckee about those PMIs and get the shifting views that these ladies were alluding to from Bill Dudley.
Well, first, PMIs. It's been a bit of a data desert this week. Now we get something that Wall Street can hang its hat on, which is the unfortunate drop in manufacturing PMI. Of course, next week, next Thursday, a week from tomorrow, we get the ISM manufacturing numbers, which will matter more. But this does suggest that there's still weakness out there, which will lead us into Bill Dudley in a minute. Services PMI, though, goes up. So the service industry is still doing reasonably well. And that is reasonably good news, since that's the biggest part of the economy. And the U.S. is better off overall than what we saw in Europe today. Some really dismal numbers there where they're all testing 40s, not going into the 40s, going below the 40s in manufacturing. UK, the only real standout at this point.
And we are hearing from the Bank of Canada cutting its key interest rate 25 basis points. That was as expected. But like you said, it has been a data desert. I feel like we haven't seen you in weeks. We do get more data at the end of the week, which I'm sure we'll parse over PCE. But let's talk about Bill Dudley. We've been alluding to it.
the Bank of Canada. I'm stuck on that for a second.
Back to back.
Yeah. And they were the first to cut, right?
They were the first to cut, and they've been looking at a real estate issue like we have here, and high mortgage rates, and
But they're doing something about it.
They're doing something about it. They feel they can, and as you were referencing, Katie, Bill Dudley thinks the Fed should be doing it not in September, but next week in July. And he quotes John Maynard Keynes saying that facts have changed, so I've changed my mind.
And his opinion, of course, carries some weight, not because of his current role, but the role that he did hold. And I mean, so he's changed his mind. He's saying next week. Is there any possibility of that happening? We were just talking about how this isn't a Fed that likes to shock the markets, and that would be shocking.
That would be shocking, and that's why I would lean against the idea. He's looking at the SOM rule as his major number, where if you go up half a percentage point from your low, you end up going into recession in unemployment. The Fed doesn't get unemployment before their meeting. It comes out the Friday afterwards, but it's not forecast to go up at all. It's supposed to remain at 4.1%. If that's the case, it won't trigger the SOM rule. But if it does, there'll be a lot of ex post criticism of the Fed. So it'll be interesting to see whether they at least say something about it. They're expected to set up the idea of a September cut.
You think about what Powell was saying about balancing growth and jobs at this point. It's not just about the jobs, is it anymore? What about the rest of the potential to slow down? A part of what Bill Dudley was saying here was this worry about an unnecessary recession being prompted by waiting too long.
Yeah, he doesn't expand on that too much, but it's an interesting point for him to make. And people have pointed to the Beige Book, which shows a majority of Fed districts see flat or declining growth. And some of the numbers that we've gotten recently, existing home sales yesterday, were bad, and then you throw in this PMI. So he's making the case that the Fed doesn't want to wait too long. What's interesting is you mentioned, Katie, that he has influence, except not in the markets, because the betting in futures markets and interest rate swap markets shows that the markets do not think the Fed is going to move next week.
But isn't it fun to think about? Maybe don't trade on it.
It would make my day more interesting.
Yeah.
All right, we do see the loonie erasing its gains. The Canadian dollar after the Bank of Canada cutting interest rates in their 25 basis points. Very interesting stuff. Michael Mckee, thank you very much. Great to see you here in the same city as we are. You can follow the Bank of Canada news conference by typing Live Go on your Bloomberg terminal. That's coming up at 10 a.m. New York time. Coming up on this program right now, top Democratic donors are planning get-rich-quick ideas for Vice President Kamala Harris's campaign. In the focus of Wall Street Beat, we'll talk about Democratic fundraising. This is Bloomberg.
This is Bloomberg Open Interest. Let's take a quick check on stocks right now because there is a lot of action in this market. The S&P 500 sinking right now, down more than 1%. The NASDAQ 100, I'm going to go ahead and call that a plunge. We are nearing a 2% intraday drawdown on your big tech index. Meanwhile, the small caps, your relative outperformer, they were earlier, as Matt Miller said, but now sinking a little bit in sympathy. You can see the Russell 2000 down about 0.3%, Sonali.
And we want to switch gears, talk about the Wall Street Beat here. The Wall Street's top Democratic donors are on a mission that is raise a lot of money and fast. They have sprung into action to fill the campaign for Kamala Harris to help close the fundraising gap between her and her Republican opponent, Donald Trump. For more, we are joined by politics editor Laura Davison in Washington. And you think about the meeting that was called on, this big hitter meeting. You had Senator View's Blair Efron, Brad Karp of Paul Weiss, Mark Lazary, Ray McGuire of Lazard, and of course others invited like Cravath's Faiza Saeed, Roger Altman. What's to come of this? Is part of this, Laura, the worry here that not enough money will be raised fast enough given how much has already been spent?
Yes, that is the huge worry. Democrats right now are going into this fight with Kamala Harris with less money in the bank than Republicans, and they have little time to kind of organize and get going. They had, sort of the Biden network. That network had largely been tapped. There was a lot of malaise, particularly over the past month, as donors said, look, we're not going to give any more. But Democratic donors are realizing there's a moment right now that people are excited about Harris and want to give, and realizing they only have 3.5 months to raise more money. So they're looking at how can we get out there and do this quickly. So they're looking at things like, can we do Zoom calls? There's a Zoom call that the campaign actually just scheduled for a couple weeks from now that is from anywhere from $25 to over $6,000 to attend, because they realize they need to they don't have time. Harris both has to do her job as vice president and campaign, and they just can't get her physically to enough fundraisers in the next several weeks.
I saw a tweet from a venture capitalist, Matt Turk, Laura. He says Silicon Valley is pivoting from Trump to Harris even faster than it pivoted from crypto to AI. Is that true? Because of all the big names out of Silicon Valley that we've been talking about, Andreessen and Horowitz and Thiel and Musk, all of those names are giving to Republicans. So are we seeing Silicon Valley deliver for Kamala?
Yeah, the same efforts we're seeing on Wall Street, we're also seeing in Silicon Valley. They're having the same kind of conversations of how can we start to raise money. This is, all politics are at its core local, and Harris, represents California. She is from there. She has personal relationships with some of these people. So some of the folks who may not have been as inclined to give to Biden are now coming out of the woodwork to give to Harris.
All right, Laura Davison, you've been a busy woman tracking all of it from the politics to the money. We thank you for your reporting. And guys, it's really interesting. I mean, so much money is being raised, so much money has been spent. And it reminds me of the conversation that we were having with Mark Douglas of Mountain just a couple days ago, that is it being spent effectively, efficiently? Have you seen these ads for all the money that's being spent?
Have you?
Really,
I haven't seen any of
They haven't
these
been very
ads.
visible.
I don't watch a whole lot of cable television outside of Bloomberg.
You're
TV.
on cable television.
Maybe that's why I'm not watching it. But, you know, it's interesting. I haven't seen much of the ads. But the interesting thing here is there was a divisiveness before heading into this moment. It's not like a lot of the people that are on the fence are now going to step around and donate big dollars. They don't know what they're all going to do yet. And the clock is ticking. That's the problem here.
All right, I haven't seen any of it, and I've been worried ever since Mark Douglas told us that, because I hate it when money's spent inefficiently.
Shouldn't they spend it on cable TV ads? I don't know.
Or, you know, put it on radio or have it on my socials, you know. I guess Facebook had problems with that in the last election. Coming up in the next hour, Stephanie Guild, Robinhood Financial, head of investment strategy, joins us. She says the market is due for a near-term correction. We are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
I'm Sonali Basak.
And I'm Katie Greifeld.
And coming up, tech disappoints. Tesla posts its fourth straight profit miss as Alphabet faces pressure to keep up on AI.
Blackstone's mortgage REIT cuts its dividend by 24%, just days after Carson Block warned us that it may face a liquidity crisis.
And Wall Street's Democratic donors spring into action to quickly fill Kamala Harris's campaign war chest. We've got the scoop on their plan. But before we get there, let's take a check on these markets right now, because we are at session lows on the NASDAQ 100. Your big tech earnings really disappointing, and you can see that in big tech, down about 2% or so. Same story if you take a look at the S&P 500. Of course, a little bit blunted since it is a broader index, but still, the S&P 500 down about 1.3%. And all the while, you take a look at the bond market, it is crickets over there, very quiet. The 10-year yield currently lower by about 2 basis points. We've been hanging out around these levels for quite a while, Matt.
On treasuries, right? But we see stocks losses get worse and worse throughout the session. Okay, we've only been trading for 31 minutes, but we're now off 1 1/3% on the S&P. We're now off more than 2% on the NASDAQ. We have big losses at Google. Almost 4% are the losses for Alphabet. And then we've got Tesla down right now 13%. So big tech earnings really off to a bad start this quarter. Tesla missing its profits for a fourth quarter in a row. Alphabet under pressure as it ramps up spending to try and compete with AI rivals. Joining us now is Mandeep Singh, Bloomberg Intelligence Senior Technology Analyst. Let's start with Google, because we've been talking about Tesla all morning long, Mandeep. What's the problem that investors want to sell it off to this extent? With Musk, it's understandable because he asked investors to sell his shares, right? Google, Alphabet doesn't want you doing that.
Well, they didn't tell us much in terms of how much the capex will grow in the second half. They said it will sequentially increase, but I guess that could mean anything. And I think investors right now are focused more on what kind of capex increases we'll see from them. And that's why they ignored the positive, which was, to me, the search business is very robust right now. It's actually accelerating. And cloud, I mean, they actually quantified the AI contribution to cloud. So both were positives. It's just YouTube miss and the capex uncertainty is what drove the stock down.
Well, let's talk more about the spend, because when it comes to AI spend, it seems like investors were happy to see that for a while. Of course, AI has been the topic du jour, but now it feels like it's turning into more of a show me story. And so far, Alphabet doesn't seem to have the ROI to back that up. Are we going to see something similar from the rest of big tech once they report?
Absolutely. I mean, I expect when Meta reports next week, and given Meta had a negative reaction last time around when they talked about increase in capex for the year, I fully expect a similar reaction to Meta. Microsoft could be mixed because Microsoft is way ahead of everyone else in terms of monetizing AI, both through the infrastructure side as well as their Copilot. So it'll be interesting to see what kind of capex increase Microsoft has. But clearly, I think Meta may see a very similar stock reaction.
You know, there's been a lot of pain in the tech world today. Of course, we're talking about that NASDAQ 100 down, but of course, Tesla is the worst performer in that market right now, down more than 11%, still almost 12%. And Mandeep, what's the read-through here? You think about their commentary around the robo-taxis and as well as their commentary about working potentially with XAI. Where's the hope here?
Well, so clearly, I think they're the furthest along when it comes to the autonomous software, along with Waymo. And we didn't talk as much about Waymo last night because Alphabet has so many other things to talk about. But clearly, Tesla will have a product. It's just they didn't manage expectations very well, you know, by giving a date in August and then moving that to October. So clearly, I think it's a case of letdown and now more about what can you show in October. But they still are the furthest along when it comes to, you know, this large addressable market in robotaxis and autonomous driving.
Mandeep, we appreciate you so very much. That is Mandeep Singh of Bloomberg Intelligence. And joining us now is Stephanie Guild, Robinhood Financial Head of Investment Strategy. You look at moves like today, Stephanie. Do you sell the news or buy the dip?
It's a good question. I think a couple things. One is that we landed. And we also had very elevated expectations from the tech supercycle. And so you have this sort of valuation move. You want to focus a little bit more, I think, on the things that have been underperforming all year. And yes, small caps are up 10% in the last month, but I still think there's more room to run. So I don't know if you buy the dip, you don't necessarily need to sell either. You can kind of, I think it's a stock picker's market.
You can
right?
buy calls, right?
You can sell puts. It all depends on what you're looking at. But you want to be specific about what you want to own. And thematically, I think we landed. And that's why you can start looking at more cyclical names as well.
Well, everyone at this desk knows that I want to get to the small caps, but let's meditate on big tech earnings for a little bit longer. Because as I asked Mandeep, I mean, it really feels like for AI spend, it's turned into a show me story. That's certainly the story with Alphabet this morning. I mean, how much more of a narrative would you expect that to play when we get to some of the other names in the Magnificent Seven?
Expectations are elevated. Sentiment is high. You know, there's a lot of analysts that have buy ratings on all of this stuff. Google had 75% of analysts on, you know, have buying ratings. I just think that whenever you have high sentiment and elevated expectations, and I always say, like, the only thing that matters is what other people think when you're going into earnings. And other people think that they should continue to outperform expectations, and when you don't on any single level, you're just going to see some softness. But honestly, Google it's not down that much. Like, it's not terrible like Tesla, and it's relative to how they've performed.
I keep going back to Goldman Sachs analyst Jim Covello. He is skeptical on AI, and he points out that most technology transitions replace an expensive thing with a cheap thing, right?
Yeah.
And here we're replacing labor essentially with very expensive chipsets. I mean, $40,000 for a chipset from NVIDIA. Are we getting a little ahead of ourselves? I mean, not on that stock specifically, right? But just on the broader theme.
On the broader theme, like maybe in the near term, right? Like every super cycle, especially the one in the 90s, got a little ahead of itself as well. It ended up being the right thing, but it can have moments where it gets ahead of itself a little bit. But you did see Vertiv earnings, perhaps, and that is related to the AI story, and they had a really robust earnings. And so I think you can still have pockets that benefit from it.
Stephanie, I want to go back to something you were saying earlier, this idea that we've landed. Because you look at the column by Bill Dudley this morning, for example, and one point he makes is that if we don't get that July cut, we extend to September, the Fed risks an unnecessary recession. Who knows how deep that would be. But if there are more troubles in the economy ahead, you're seeing some now. You're seeing it wide open in earnings season. Is there a risk that we haven't landed?
You always have a soft landing before you have a harder landing. I still think there's room to have it be, you know, that this is the landing. I don't think that if we don't, I actually don't think we'll cut in July at all. And September is really where I think it could end up happening. And I do think it will end up happening, and then it will continue. I think the one thing I am watching is jobs. Like, the consumer is slowing down, but I think that's just kind of a normalization rather than it being something worse than that, because they are spending in services. They're just not spending on goods anymore as much as possible. And so I think that's why you're going to end up, I do think we landed, as I said.
And taking the other side of the Bill Dudley trade, a lot of people are this morning. But I do want to go back to small caps, because with the idea that we've landed and we are seeing maybe some wobbles in that AI story, and at the same time, that rotation that we're seeing into small caps, when you think about the index and the markets as a whole, are we going to see a catch up for small caps? Can that continue, or are we going to see a catch down for big tech?
I think it's more of a catch up, but big tech has high expectations. So you are seeing a bit of a rotation, right? You've seen it from tech to financials, industrials, and that's why small cap gets the best, because 17% in industrials, 18% in financials in the small cap space. So I think it's going to be a little bit rough for tech in the near term, but I still believe longer term in this tech super cycle. So I just think it needs to go through kind of a revaluation.
Any Trump trade thoughts, Stephanie? I mean,
or Harris trade.
Or Harris trade. I mean, it's more likely that you have thoughts on, Trump policy that he's talking about on the campaign trail. Is he actually going to put it into action on immigration, on taxes, on tariffs? And then how does that play out in your portfolio? Not for traders, obviously, but for long-term investors, I think it really matters.
Yeah, I mean, the Trump trades definitely poured a little bit of gas on top of the small cap rally, I think, and the rotation. But when you look, I think it's much harder to get taxes done in an environment where we have a rising deficit. And definitely, I think it could end up being like a split Congress. So that will be a little harder to get done. But the one thing that any president can do is implement more tariffs without having to get permission from anybody else. And that, we know from the 2016 to 2020 era, was really hurtful for certain sectors. I specifically remember like fertilizer companies, not getting as much business from China. And that could end up being hurtful for some tech companies that have a ton of revenue.
And for the Fed, right?
Like
I mean, your take is that they don't cut in July, they do cut in September, and then they continue to cut.
Yes.
Now, if we get tariffs across the board and 60% on China, do those cuts turn into hikes?
It's a good question. It definitely could be inflationary, because we know that tariffs, we would pay as consumers for the tariffs. But I actually think there's enough kind of slowing down elsewhere that we don't necessarily need hikes. And I actually think that cuts can actually contribute to deflation or disinflation. Because I think it will pull some pressure off the housing market, which has been the stickiest part of inflation.
And that, of course, would cause a bit of a feedback loop, of course, feeding into more cuts. Stephanie, unfortunately, we have to leave it there. Okay. Great conversation, as always. Hope to see you back soon. Our thanks, of course, to Stephanie Guild of Robinhood Financial. Let's get a look at what's moving underneath these markets right now. Here's Abigail Doolittle.
Well, we do have stocks at session lows. The S&P 500 down 1.4%, the Nasdaq 100 down more than 2%. Let's start off with a bright spot, though, and that is AT&T up 4%, the best day of the year. This after they added more subscribers than expected, fewer current customers dropped, so churn improved, investors liking it. To the downside, though, of course, we were just talking about some of these big tech earnings movers on the day. Tesla right now down 12%, earnings missed by about 14%. Investors looking past the sales beat. I would argue that a lot of this has to do with the fact that from trough to peak, from the April bottom, the stock up more than 90%, too far, too fast for those results. Alphabet down 3.4%. There was some YouTube weakness. In addition, higher CapEx spending, but it's similar to Tesla, investors looking past some of the surface beats. This appears to be a piece of why the market is down, because if we take a look at some of the other big tech movers, we have the likes of Nvidia, Meta, Apple, Microsoft, all down significantly. Not a lot of specific news here, so some sympathy, Matt, with that Tesla Google trade to the downside. I would argue it also has to do with election uncertainty. The VIX back above 16. We may know who the two candidates are, and I still stress the idea of may, but we are obviously in an unprecedented election cycle, and that will take a toll.
All right, Abigail, thanks very much. Abigail Doolittle looking at the stocks that are dropping, pulling this market down. Losses on the S&P 500 of almost 1.5%, more than 2% on the Nasdaq. Coming up, we're scheduled to hear from President Biden tonight, and we will see him reportedly as well. It's his first speech since dropping out of the presidential race. We preview tonight's Oval Office address next. This is Bloomberg. Now to high interest, to look at what's making headlines around the world. A Swiss watch brand owned by French luxury conglomerate LVMH is in talks to take over as the official timekeeping sponsor of Formula One. Of course, now it's Rolex, and it has been since 2013. This deal would represent one of the most high-profile and expensive marketing agreements in sport and would deliver a blow to Rolex. The brand, by the way, is Tag Heuer. Just so you know what you might be seeing at F1 races going forward. Aston Martin saw strong demand for its pricier limited edition supercars in the last quarter. The British car maker boosted its average selling price to $353,000 and offset an 11% drop in deliveries. The shares jumped on the surprising demand despite the drop in sales driven by a drop in their DBX, which is a great car, so maybe you should pick one up. CrowdStrike says that a bug in a quality assurance tool that the company uses to check updates for mistakes allowed flawed data to go out to customers, causing last week's global meltdown. The company says in an incident report that its content validator malfunctioned and let the bug pass through, kicking off one of the most spectacular, probably the most spectacular, if you consider it that way, IT failures in history, Katie.
And we do want to turn to politics now because Vice President Kamala Harris officially launched her bid to the White House with a rally in the swing state of Wisconsin. Now, Harris attacked Republican nominee Trump, referencing her past work as a public prosecutor.
In those roles, I took on perpetrators of all kinds. Predators who abused women, fraudsters who ripped off consumers, cheaters who broke the rules for their own gain. So hear me when I say, I know Donald Trump's type.
And David Gura, he is the host of Bloomberg's Big Take podcast. He joins us now, and we're going to talk about Harris, but let's talk about Biden, actually, because we're going to see him tonight for the first time in, it feels like a week now.
It's been a while. So, of course, he had COVID and was at his home in Rehoboth Beach, Delaware, and we were kind of wondering reportedly, okay, fair enough, what this kind of announcement might be like. Of course, when LBJ decided not to run in 1968, we didn't have social media. He couldn't push a memo out, but that's how this happened. We got a memo on Twitter, on X, from President Biden saying he wasn't going to run again, and then teasing the speech that we're going to get tonight. So we will have that Oval Office moment in Washington tonight, 8 o'clock p.m., and as he said in that letter, he's going to explain his decision to the American people, but we haven't seen him. He called in when Kamala Harris made her way to campaign headquarters in Delaware. It was basically just on speakerphone with a microphone speaking to the staff. So it is an high-tech, an important moment.
Before we move on, can we just get your take on why on earth the president would tweet this out? And I don't think it matters as much as the conspiracy theorists on Twitter do, but why would he tweet it out instead of just putting it out on his own White House website?
Well, a great question, and I think a lot of people taking a victory lap within X saying it's the preferred platform for doing this, but it got around quickly, as you saw it did. People still picked it up. It maybe re-energized Twitter a little bit.
You think that's why Joe Biden did that? He wanted to re-energize Elon Musk's
I don't think that it was
Twitter?
his decision necessarily. And I'll give him the benefit of the doubt that he was probably too ill to give a speech that night. But I think you're right. It's been many days, and that's a bit strange, I think.
David, a little earlier we were talking about how large Democratic donors have been trying to rally around Kamala Harris at this point in time. You spoke to one of them yesterday, Barry Diller, of course, another billionaire founder of a large media company that is not X. So what did he have to tell you?
Yeah, I reached out to Barry Diller, who, during the course of the post-debate weirdness, when there was kind of concern of whether Joe Biden would continue, so that he wasn't going to back him anymore. And that's a big deal given his long history. He and his wife have a long history supporting Democratic candidates. He got back to me yesterday and said he has been excited by what he's seen on the campaign trail. You see the statement there that he gave me. Anyone who doubts Kamala Harris's political expertise should pay attention to how she's perfectly handled every step post-Biden's exit. Has been just a few days. I will donate the maximum to her campaign. So he's back. He's giving money to the campaign. We've seen such an outpouring of donations, both at the small dollar level and the big one. And today, a number of big meetings are taking place. One of them is being convened by kind of historic big Democratic donors on Wall Street. So Blair Efron, Ray McGuire, Peter Orszag. They're going to get on the phone and talk about their strategy going forward. But this was a campaign that had a lot of money, spent a lot of money in June, and has been really trying to find its footing to get back on a sustainable path to getting money to finance the campaign. They're hoping that this can kind of carry that forward.
Well, lucky for them, it appears that there's a lot of donor cash on the sideline looking to spend and donate right now. And to that point, do you get the sense that the people who are donating to the Harris campaign are donating because they're pro-Harris, or are they simply anti-Trump?
I think it's a mixture of both, but we've seen so many of these small dollar donations, and you look at the strategy from the campaign about how Kamala Harris changes their calculus and perspective going forward. They see this as an indication that they're going to be able to bring people back into the fold who maybe were inclined to sit it out when Joe Biden was the nominee. So they're presenting a very rosy look and saying they're going to be able to bring more people in, grow that base of support going forward. And they're counting on those small dollar donations still.
You know, at the end of the day, it's never really about the donors, it's about the polls. The donors help you get to the polls sometimes. At the end of the day, what does the VP pick mean for her ability to maybe capture some of these swing states and beyond? There's a debate about whether a swing state VP would just get you the swing state.
It's a huge debate, and she's figuring this out. Eric Holder, the former Attorney General, helping her do that now, who would be the best pick for this. I will say we're getting some early polling now showing how she would match up against Trump, and one is a Reuters Ipsos poll that shows her actually with a small edge ahead of Trump. There's an NPR PBS NewsHour Marist poll that shows her maybe a point behind, but within the margin of error. So that's a positive sign for the campaign, of course. But this is something that's going to be, she'll be on the campaign trail. She's in Indiana today, Houston after that. She's really hitting the ground running. But certainly her focus is on picking that running mate, and her campaign's focus as well.
I just want to point out, we have a great function on the Bloomberg terminal, WSL election. If you type that in, you can get the betting markets take on this and some polling averages. The astronaut from Arizona is leading, Senator Mark Kelly, with 42% right now. Josh Shapiro, governor of Pennsylvania, at 21%. And I just think it's a fascinating, market to watch, because polling has been so bad. And the question is, can betting markets be better?
It is an open question, I should say, but you're right about polling. And I think that in the waning days of the Biden re-election bid, he was really casting a lot of doubt on those polls in a way that, who's to say whether he was right?
Well, it didn't seem like he was seeing any of the polls.
He wasn't doing well. It didn't seem like he was seeing them, and he was casting doubt on them. But you raise a good point, which is I think there's been a lack of faith in, or maybe not valuing those polls as much as we had in the past. So it's certainly I would say a good compliment to what we're seeing in the polling to look at the betting markets.
David, thank you so much for joining us. Of course, that is Bloomberg's David Gura. We will have full coverage of President Biden's address tonight. Don't forget, at 8 p.m. New York time. And don't forget also, you can listen to David's podcast on Apple Podcasts, Spotify, or wherever you get your podcasts. Still ahead, we'll take a look at the companies making the most buzz on social media today. That is Social Climbers up next. This is Bloomberg.
All right, time now for Social Climbers. The company's making waves on social media this morning. And first up, T-Mobile and KKR forming a joint venture to buy Metronet. T-Mobile will invest about $4.9 billion to take a 50% equity stake. The wireless carrier will use Metronet's digital and fiber infrastructure to expand to more households. And next up, we have Blackstone Mortgage Trust, which provides financing for commercial real estate, cutting its dividend by 24%. Now, the cut comes as defaults increase and borrowers increasingly struggle to make payments or refinance their loans. And guys, we got to take a look at markets right now because it's turning into a moment, of course. You take a look at big tech down about 2.2% on the NASDAQ 100, Matt.
Yeah, absolutely, and continuing to fall, right? So we're looking at a loss of 1.5% on the S&P 500. These big tech stocks that reported disappointing earnings, Tesla for the fourth quarter of the row, combined with, I think, global indicators, right? UPS yesterday, Otis today cutting its outlook. LVMH looking at a 14% drop of sales, give real concern about the slowing down of the economy, and with investors waiting for a rate cut that they aren't likely to get in July, they're selling stocks instead. We're going to speak with Mike Brown next, the CEO of Travel and Leisure. This is Bloomberg.
Now, one stock we are watching this morning is Travel and Leisure. Shares are falling after the company issued a weak forecast. Joining us with more across the travel sector, of course, is Bloomberg's Abigail Doolittle.
Well, it is a pretty brutal day here for the shares of Travel and Leisure, down about 8%. The worst day, in fact, since June of 2022. So let's break it down because it's not all bad in terms of the quarter that was reported. Earnings, in fact, beat by 9%, and sales, there was a modest miss, but you can see when we take a look at it in the perspective of the recent quarters that sales of nearly $1 billion was basically a sequential gain from the first quarter and in the zip code of the last several quarters. What is weighing really is that guide that you were just talking about in terms of the third quarter EBITDA guide being just a little bit weaker than what the street was expecting. Katie, I think that there's one other factor going on, though. If we compare the shares of Travel and Leisure to the S&P 500 and the overall travel index, we are going to see ahead of today and just recently big outperformance into today. This stock had been up 26% on the year, really outperforming the S&P 500 and outperforming the travel sector, which has basically been down or flat. So maybe a little bit too far, too fast. Some investors just taking a few chips off the table.
All right, Abigail Doolittle, thank you so much. And let's keep the conversation going now with Mike Brown. He is the CEO of Travel and Leisure. And let's start, of course, with that guide that seems to be really weighing on shares this morning. You take a look at third quarter adjusted EBITDA between $235 million to $245 million. The estimate was for about $253 million. Give us some context on why you guided lower than had been expected.
Well, let me step back and look at the full year guide. On our earnings call, we actually raised our full year guide from where we were in the previous quarter. And what we pointed out on the call is the cadence of those earnings between Q3 and Q4 was just a little misaligned to the street. The great thing is, even though our Q3 guide was a little bit lower, our full year guide not only met our previous guidance from Q1, but we actually raised it a little bit. So that's more a matter of guiding between quarters than it is our full year expectation. In the end, our underlying business is really performing strong and reflecting a consumer demand that's very high this summer and what we expect for the remainder of the year.
I do want to talk about the detail that I noticed that there was a higher than expected loan loss provision. Some of the sell side notes focusing on that this morning. What does that say about your lower end customer? Of course, we talk all the time about the weakening consumer here, and you take a look at this higher than expected markup. What are you seeing there?
Well, I think there's nothing different in what you're seeing at our company than you're seeing in the macroeconomy. Is when you get to the lower end consumer, which is anything we're defining as below 700 FICOs, those consumer finance portfolio numbers are slightly weaker. 76% of our portfolio is above the 700 FICOs. So I don't think for us there was any surprise that you would expect to see a little bit more weakness. It's reflective of what we're seeing in the macroeconomy, and people are reacting to it. I was listening before the break that there were a lot of companies that were lowering their guidance over concern in the consumer. For us, we're the opposite. We raised our guidance despite what we're seeing in a $3 billion consumer finance portfolio. We're simply reflecting what others are seeing in the market while raising our full year guidance and reflecting strong consumer demand in the last 2 quarters of the year.
Mike, how do you describe what's going on in the travel market here? If there are a lot of worries kind of across corporate America here about middle to lower end consumers, lower income consumers, then how do you think about who's driving most of the spend? Is it these big spenders going to higher end locations, or is it people who are just trying to spend a summer break more locally?
Well, we're a 100% leisure company and leisure travel company. And what we see, just the nature of our business, which is prepaid vacation, is when the economy tightens, people will not give up their vacation. I think we saw that in 22 and 23 as people returned as fast as they could to getting on vacation after the pandemic. What you will see is a change of behavior as to where their spend will be. They may decide to come to a regional destination that allows them to save some money on a drive to versus a fly to. We're seeing our biggest demand in your traditional vacation spots, Orlando, Las Vegas, Las Vegas and the beach destinations in the summer months. So the consumer is very wise. They make clever decisions based on where the economy is. And with a little bit of uncertainty ahead for the second half of the year for our consumer, they're just driving maybe a little bit more and choosing to spend their money. But what they will not do is give up their vacation in our space, which is prepaid vacations.
I'm curious about your view into the second half of the year. At this point, Mike, are you most concerned on behalf of your customers here for high pricing that remains even when you see inflation kind of cooling here? Or is it the fact that people are worried about the economy and growth slowing down, maybe even a recession?
Well, I think whether it's travel decisions or investing in the stock market, uncertainty is always an element that gives people pause. So I'm not concerned that our consumer, which 80% of them have fully paid for their vacation, are not going to go on vacation. We actually sit very well because it's value driven and people can really use their money how they choose to. But when I look more broadly at the leisure travel sector, I think whether it's interest rates, an election, or the macroeconomy, taking uncertainty off the table will be the best thing for the travel consumer in the second half of this year.
You get the lion's share of your revenue from timeshare sales. Is that right? Vacation ownership, is that timeshare sales? And what is that consumer? What is the profile of that consumer?
So our consumer, on an average, has a household income just over $100,000, and our average FICO score is about 740 for all of our new originations. So it is a strong consumer. And over the last 3 years, what we've seen is that the inflation has actually been a tailwind for us, because if you've paid for your vacation in 2016 and your neighbor who doesn't own a timeshare is vacation at 2023 prices, you're seeing tons of value. And most of our consumers are about in that high 40s, early 50s range, but we're starting to see about 15% be millennials and 15% millennials, and we're starting to see our first Gen Z purchasers in the past 2 years.
I wonder about a new segment you have, which is a Sports Illustrated vacations. Yes. It sounds totally cool, right? And I think, for example, I could go to University of Alabama, and I hope I don't get a lot of haters writing in, Roll Tide. But what does that segment look like, and how is the growth trajectory?
Well, I can pretty much assure you you'll get some Auburn fan base comment. The War Eagles, that's right. But I think hospitality is in for a different macro trend. People are looking for experiences that relate to their personal life. And we already have the Margaritaville brand. And when I say the word Margaritaville, you think, sand with a margarita in your hand. And when you talk college athletics and Sports Illustrated, you think of a certain clientele that wants to have a certain experience when they go to the University of Alabama, or another one of our resorts that will be bringing forward in the college town scenario. People are passionate. College sports is a passion location, and I think it's fair to say, if you want to associate your sports experience with your alumni experience, there's not many hospitality offerings out there. So we're excited to bring the most iconic name in sports to hospitality and to tie it into the passion of college sports.
Well, my college didn't even have a football team, but that's a whole different conversation. Before we let you go, I do want to ask about some recent acquisitions you made, the Accor Vacation Club, for example. Cool. When you take a look at your portfolio and future growth, are you considering more acquisitions of that type?
Well, what we believe the future of the industry is to grow your the range of your consumer. We have a very close relationship with Wyndham Hotels, and that relationship has led us to over $2 billion of vacation ownership sales that we're projecting this year. We think that same business model is replicable at Margaritaville, at Sports Illustrated, at Accor, and what could be future other brands. We want to keep our eye on the ball, so we'll be very discerning in any other acquisitions or partnerships we make. But we absolutely believe the vacation ownership platform will be expanded by the addition of incremental brands that are iconic as well as incremental databases that is supportive of our business model, which is a direct marketing business model.
Mike, thanks so much for joining us. Really fascinating stuff. Mike Brown there is the CEO of Travel and Leisure. Let's get a check right now on the markets. We are seeing big drops across the board. For that, we go to Bloomberg's Abigail Doolittle. Abby?
We are indeed, Matt. We do have the NASDAQ 100 and the S&P 500 at session lows. Here is the S&P 500 right now down 1.5%. So continuing last week's weakness, I would suggest that some of this does have to do with uncertainty around election 2024. If we take a look at some of the other indexes, I was just mentioning that NASDAQ 100. This index now, I believe, on pace for a third down week in a row, down 2.3%. You can see small cap outperforming, but still down 0.3%. I would really like to point out, take a look at this NASDAQ 100 VIX at a 21 handle, a big spread to the S&P 500 VIX, or the VIX, at 16. Both of these indexes measure uncertainty. So uncertainty rising, but the fact that you have such a big spread between those two suggests that there could be more volatility as the likes of Apple, Microsoft, Tesla, Google are falling on the day. And then take a look at this, making it a bit of a risk-off day. We do have that 2-year yield down 10 basis points nearly at a 4.39. That tells you investors are going toward bonds. Now, we have all kinds of breakdowns on various indexes. We were taking a look last week at the one on the NASDAQ 100. Let's take another look at the chip index, because NVIDIA and Broadcom, two of the bigger drags on the day. This is the chip index. This is the 50-day moving average, and today we are gapping below it. That is pretty bearish. That tells you that investors are surprised by the degree of bearish selling that we have today. You can also see the RSI, a momentum indicator, going down out of overbought territory toward oversold. The last time we went below the 50-day moving average, it was back toward that April bottom. Not much to see there. The big question is, will this continue? Will it be just a brief blip below the 50-day moving average? Or is there something more that investors are mulling over here where it could be a bigger correction? We don't know yet, but there are a lot of bearish divergences beneath the surface. Stay tuned.
Yeah, absolutely. And the stock's down another 2.5% today. It is just ugly out there. Abigail Doolittle, thank you so much. Now, coming up, former U.S. Treasury Secretary Larry Summers weighs in on the 2024 race as Kamala Harris ramps up her presidential campaign. This is Bloomberg. Well, it's time now for our daily Wall Street Week conversation. And inflation, of course, is at the heart of economic issues this election cycle. Prices are starting to cool, but voters' perceptions still run hot. Wall Street Week's David Weston asked former Treasury Secretary Larry Summers what we know so far about Vice President Harris's economic policies.
We don't know much yet. The campaign's only been going for 2 days. But I think we've got some strong bases for optimism. First, it's been the Biden-Harris administration, and if you step back, it really has a remarkable record. I don't think any administration has so outperformed the economic forecasts on the day that it came into office as the Biden-Harris administration has, and that's because of an approach that is about investing in America and investing in America's future. And if you look at some of the things Vice President Harris has done, they have that orientation to the future. She knows that our children are our future, and that's why the child care credit and investing in children, investments that reduced the child poverty rate by a half when they were in effect, were so important to her. She knows that fiscal responsibility is central, and that's why she puts emphasis on the fact that we need to raise taxes where it is replacing the ineffective, massive corporate tax cuts that President Trump put into place. She understands that much of our future lies in exporting to the rest of the world. It's not her approach to call Africa and El Salvador countries, as President Trump did. It's her approach to work to strongly support their development because she knows that more prosperous countries around the world make for a more prosperous United States. She knows that there's a strong role for the market system, that we need businesses to succeed if we're going to create jobs in the United States. She knows that actually better than J.D. Vance did, judging by his comments at the Republican convention. But she also knows that we need strong policies, strong regulatory policies if consumers are going to be protected, strong environmental policies if we're going to protect the planet. Look, she is focused on the future, and our future lies in technology that empowers and strengthens workers and that works for American children. And that's going to be, I believe, the focus of her administration. And it's a new generational approach and a stark contrast with what came before with Donald Trump. And judging by what he's saying on the campaign trail, a even larger contrast with what would come if he were elected. What he describes, David, is a prescription for massive inflation. Ignore the deficit, bash the Fed, trash the dollar, cut back on labor supply by trying immediately to send millions of people home, stop subsidizing clean energy, and put massive tariffs on so businesses can't get cheap inputs. It's hard to imagine a better strategy for creating inflation, for creating high interest rates than the Trump strategy. President Harris, I believe, will avoid all those pro-inflation mistakes, and much more important, will build a future-oriented economy through our kids, through our technologies, through containing our debts, and through working with the world.
And that was Wall Street Week contributor Larry Summers with our own David Weston. And tomorrow we'll hear from PGIM CEO David Hunt. That's on Wall Street Week. This is Bloomberg.
Let's get to the trading diary, what you need to be watching today and this week. Israeli Prime Minister Netanyahu addresses Congress at 2 p.m. this afternoon. Plus, Fed speak from Bowman and Logan at 4 p.m. And President Biden will be speaking at 8 p.m. from the Oval Office. Tomorrow, we get U.S. GDP and durable goods numbers. And then on Friday, we'll get inflation in the form of the Fed's preferred gauge, PCE. We are also watching out for results from Ford, which are due after the bell today. For a preview, we're joined by Bloomberg's Detroit bureau chief, David Welch. And David, this comes on the heels of very impressive results from General Motors. What do we expect from Ford?
Could be a little different with Ford. No, they both exist in the same economy, in the same vehicle market, and it was a very healthy one in the second quarter. And Ford sales were up a bit. Key number, though, is in the second quarter, F-150 pickup truck sales, where Ford makes all of its money, sales were down. They're in the middle of switching over to a freshened up model, and they've been holding some vehicles back for quality checks and that sort of thing because Ford has had an issue with warranty costs. And they did that in the first quarter, probably some of it going on in the second quarter because sales were down. So it all depends on how the stock reacts, rather. It depends on how much money they made on those trucks. And actually, in a weird way, if truck sales kind of, I guess, let's say gives Ford profits that don't look as good as GM's, it could actually help the shares in the sense that investors will think that there's more upside in the second half of the year as they ramp up more F-150 sales. The problem for General Motors was they had such a great second quarter and such a good first half that investors figured, oh, the good, we're at peak now. The good times are over in the second half. While it may still be healthy and strong, it's all downhill from here. And they sold off the shares to the tune of more than 6% down yesterday. So if Ford does have a little bit left in the tank because the F-150 rollout's going to gather steam in the second half as opposed to having done well in the second quarter, they could actually see some upside in the stock aftermarket and then tomorrow at open.
Well, speaking of what's left in the tank, let's talk about gas engines, because we know that Ford has been ramping up production there, and EVs, that soft EV demand has definitely been the talk of the town. What do investors want to hear when it comes to their thinking on the EV output, and what are we likely to actually hear from the company?
Look, investors have kind of looking at EVs like they're not so great now. Look at Tesla. They've had another quarter of down sales, and Elon Musk is trying to stoke the stock with an AI and autonomous vehicle story rather than more growth in electric vehicles. I think investors broadly know that EVs are the future. It's not the immediate future, and it's certainly not earnings right now. And Ford doesn't have new ones coming off a dedicated platform for a couple of years, so they don't have a great story there. They do have good sales going on with the F-150 Lightning. It continues to do pretty well, but they lose a lot of money on their EVs. So investors are more looking at near-term. General Motors, Ford, most automakers for that matter, they're making money off of their SUVs and their pickup trucks that run on gasoline.
Right.
And GM is a cash machine based on this, so is Ford. So there's going to be a lot of focus on cash flow and profit margins.
Right. All right. Bloomberg's David Welch out in Detroit. Really appreciate that. We'll be interviewing the CFO of Ford after the automaker reports results today. Tomorrow on Open Interest, a great lineup for you. Adina Friedman of NASDAQ coming up. This is Bloomberg.